What's going on, Matt?
Hey, can you hear me?
I hear you perfect, man.
Yeah, I'm in my loud. All right, cool. This is a
No,
good
you're coming.
setup here. I get to sit in my own house, office, and use my own equipment and not have any technical issues. I'm my own IT guy.
Yeah, it sounds good. It sounds good, man. Greg's in. Greg's live from Hawaii.
Aloha, mahalo.
Nice.
I'll be out in the.
Is it like 6 in the morning over there?
8 in the morning.
Perfect. Well, good.
That's one thing. If the handful of times I've been to Hawaii.
Sounds good, boys. Well, I'll be out in your neck of the woods next week, Matt, or I'll be in Bend next week. So,
Oh, you're gonna
not
go
your
over to your
neck.
sisters?
Yeah, I don't know if maybe I'll cross the mountain to come see you. We'll find out. That was eye-opening last time I did that with you.
Are you repping IFP there, Ash?
Well, I mean, I can come over there too.
I got the IFP. I'm repping the Charles De La Torre IFP banner today.
There you go. You think, yeah. I hope he's watching. I'm going to text him right now.
No doubt. Well, we got together last week, and it seems like we're in a. First of all, everybody, welcome to This Week in Lumber. Matt Beamer, Hampton Lumber Sales out of Portland, Oregon. Greg Riley, Sitka, USA. We're back in it today. Last week, we chatted a little bit about the market was getting a little bit of giddy up in it. It seems a little bit of digestion right now. Does that make sense, guys? I mean, how would you explain it? Because what I'm starting to see is, and Greg, you kind of took a little bit of a secondary market, and maybe that's because the mills or the producers raised the price so fast and there was enough bought underneath it. I'll let you guys both because I'm interested in what's going on.
Well, I guess, two things. Yeah, absolutely. I mean, the market's had from the beginning of the year, has had a really strong run. I mean, you depending on the price, low trade, items are up anywhere $30 to $40 to $150 to $175. Some prices have increased, have had 50% price moves so far this year. That's that's fairly significant. It was, I guess when I look at things, two things is, one is when the secondary market is that far below mill replacement, what does that tell me about the market? Well, that tells me that most of the players are not that confident in their position, and they're scared because they just want to liquidate that inventory. So the question will be, how quickly does that happen, right? And do mills have a strong enough shipping file to wait that out?
Yeah, that's a perfect explanation, man. I think that's right on. People that bought stuff, they're scared and just want to get out of the weaker hands, definitely. And then other people that put wood on the ground are like, hey, this is great for me because nobody's keeping any wood on the ground right now, and I'm gonna keep doing what I do, right? Matt, what's your thought on that?
Well, I think it's also a hedger's market. So I think it's the perfect hedger's market. You've got, a huge premium that developed in the futures market here in the March and May contracts the last couple of weeks. And, if you had bought a little bit of cash to ride some momentum as a momentum trade, you certainly had a big premium to sell into the boards. Now the board's down 40 or 50 bucks. That just frees people up to go create like a two-tiered market, which is what we're in right now. We have where there's fewer transactions, and the ones that are being done are by people that have a bit of either they picked up some basis money, or they just feel like, okay, I've slowed down enough, some trading going on. In the meantime, the mills are, I think most mills sold enough of an order file that they could probably sit back. I don't know, let's say this time next week. If the mills haven't done anything for the next 4 or 5 trading days, you'll see some changes in their posture. But at the moment, I think they're fairly content. And the other thing that we're not talking about is that the mills are all getting hit with a bunch of premium business now. So that home center business is really starting to accelerate. And so, I mean, that's going to change the dynamics a little bit. Some of the 15-foot premium that's been laying around out in the world is going to get dried up really fast. I've seen inquiries from the general market for 15, 20 cars of open market premium 96-inch that, those are going to the home centers, that guys are into the Rolodex to find extra premium. So there's going to be some changes here in the next 30 days that'll actually help the mills. I think the mills have actually shown that they will put, production, but they're not in any hurry to increase production. I think we're in a really pretty bad market right now. And I think time of year favors the sawmills to be patient, in my opinion. Still think they want to know what the trade's going to be. When you go up $80 or $100 in 2 weeks, there is some room for the mills to negotiate. So that's where we are right now.
Yeah,
well,
Matt,
no, let's not forget Wednesday. It's curtailment Wednesday. Don't forget.
Oh, that's there could be somebody come out. Who knows? Matt, you brought up a good point. So we were sending trucks into some of the docks, picking up stuff, and one of our truckers. It was funny. I just got an email last night, and I didn't really think much about it. He said, "Hey, I just want to let you know we're getting here early to pick these up, but all the home center trucks that are coming in are getting precedent over us, and they're loading them first. So there must be a big push on the home center stuff to get moving, right? That makes sense."
Well, their usage rates are way higher than they should be for the first week of February.
So that's interesting. That was something I wanted to talk about. What you brought that up as the home center outtake is starting to, how is it compared to the same time last year or historically this time of year?
They're a month ahead of schedule right now, buddy.
It's good to know. Good to know. Greg, you and I talked a little bit about Brian Westbury was in town, and you got a pretty good synopsis of what's going on. And what I'm noticing is stuff doesn't seem to be slowing much, man. New car or used cars, second month in a row up again, right after being down. I mean, people are looking to spend money again, right? It seems like.
Well, I mean, we're still in this situation where, while, the Fed has increased interest rates substantially, there's $5 trillion of excess reserves at banks, and consumers have an additional, I think the last number I saw was $2.5 trillion, like more cash in the bank. So there's still a lot of money going out there. And then I think, one of the things as we're talking about the home center that I thought about was this whole idea that we've talked about in all of the people that refinanced or bought homes in the last, up until 6 months ago, the prior 18 to 24 months, they have 2 3/4 or 3% mortgages. And so it would make sense is if you're in a 2 3/4% mortgage in your house, instead of moving to a bigger house, you might say, hey, let's redo, let's put an addition on. Let's do this. Let's do that. I think that's going to play into the home center business for this year.
Bathroom, guilty. I'm putting a new bathroom in.
Julie wants to do more than one bathroom at one time. And I'm like,
yeah.
Which tile do you like better? Which one's the most expensive?
Yes.
That's the one you like.
The best answer is, what tile do you like better? The answer is yes. But no, look at it, but people are busy doing the repair and remodel still all over. And our person can't start for like another month because they have so many jobs. And when I tried to counter them, they're like, yeah, do you want to do this or not?
yeah, but you're paying North Shore premium there, brother.
Yeah, no doubt. No doubt. Well, that's a good price. And you had a good part about negative cash right now, Greg, as a relative to we had all this cash going into the market a year ago, and now we're net negative.
Yeah, well, I mean, to Brian, and he's traveling a little bit. We did talk. He said like maybe later this month, or in April, we'll come on. Maybe we'll get him for March housing starts in April, which would be great. But and Brian is historically, really, really positive on things. But I mean, he was looking at money supply, and we've talked about this. The pandemic hit, and money supply expanded through the first part of last year, was up 42%. Just a massive spike, and that was all of the PPP, all of the direct deposits of cash into people's bank accounts, all of the other pandemic spending, blah blah blah. I did hear last night. I listened in, and we have the biggest decline in the deficit in the last 2 years. I think that's pretty amazing, considering we had the blowout spending 2-3 years ago. That we didn't spend that much. That's to be commended. But that's an aside. That having been said, money supply now over the last 12 months is a negative 1.5%. So that's not a positive. So we'll have to see if that kind of readjusts back to the normal. You kind of need money supply growing at 4 to 6% annualized rate to support a growing economy. So right now we're in that correcting the overdone portion, and it's a question of how much we overcorrect that.
Yeah.
So we're like way in the weeds right now.
Yeah, a lot of stuff to work through right now. Certainly, you look at a stock market that's kind of like having fits and starts. That you read where people say the bear market's over. You got all kinds of questionable stuff. One thing I've learned too is if I don't want to get confused, I just turn Twitter off sometimes.
Yeah, you should just turn it off.
Twitter's not reality, buddy.
Gosh, I don't typically when I'm walking down the downtown Chicago, and there's a guy standing on a soapbox wearing like a tinfoil hat screaming stuff, I don't really listen to him, which is like what looking at Twitter is like.
I gave that guy $5 today on the way in.
Yeah.
And you feel better. You feel better.
Did you invite him to your poker game next Thursday?
I do. I feel a lot better. Well, so let's okay. So a lot of people
I remember the guy that had the bridge, Randolph Street Bridge. I mean, that guy had like a $200,000 a year job. It was amazing. He made so much money.
And then we'd see him on the weekends in like a really expensive outfit walking up and down Michigan Avenue. So there's a lot of different people that watch this show, anywhere from people that are building one house to remodeling to large multifamily developers. I think, what are we seeing out there as far as pricing? What are we going to see for the remainder of this first half of the year? And what do you see going into the second half of the year? So what we saw last week and what we've really seen is a lot of people saying, hey, I've got, especially in the multifamily side, I have a lot of business locked in. Even at these numbers, they're great. I'm going to lock in and I'm going to try to push some risk off to Matt and Greg, or I'm going to try to push risk off to somebody else at these numbers because they're decent. What are both of you seeing? What do you see? I guess, what do you see short term? When I say short term, let's say the rest of H1 here and into the second half of 2023.
Well, I'll go ahead and start, Matt.
I'm seeing we've already got a bunch of business for we have a bunch of business for the first half of the year, and we're getting asked to quote stuff out in the September, October already. So I don't think that the multifamily guys have any fears whatsoever about these price points. And they're, I don't see any major waves there. They've been consistently buying all along through this whole downturn, and I think that will continue. I don't see that really changing in any real shape or form. The only thing that would screw that up is if we had some unknown shock to the system that pushed prices back up into the 4 digits again, which nobody expects. It's a low possibility of that happening anyhow. Why the multifamily guys are just content to kind of do maintenance. They're not putting the PO book away either.
Greg, how about you?
I mean, well, one of the things that we have to remember is that, you know, the current change in the market over the last month has been precipitated by cuts in production and anticipated cuts in production. You know, yes, in the fourth quarter, prices were at unsustainably low levels, and inventories had been through the field had been substantially drained. So you look at, you know, call it a 4 or 5 week buy cycle. Have we completely filled the pipeline back up? Probably not to the level of historical spring business, you know, even at $1 million, $2 million, $3 million level. And then I guess the other question is where, you know, is there further curtailment coming up, or have prices rebounded enough that, you know, that mills are not going to contemplate production cuts? Or how much do we make? If we make a correction here, is it just a question of like at what point in the correction that there's further cuts in production? I mean, because at the end of the day, you know, supply demand are going to balance out. So, you know, we overdid it on the downside. Have we overdone it on the upside? I don't know. It doesn't feel completely overdone yet, but you know, it certainly could be.
So we talked about
it's not even close to being overdone. There's so many people that did not buy 30 days that wish they had that, and then the people that did buy lumber didn't buy enough. So there's just still a lot of fuel underneath the fire here. If we come back $50-$60, it'll just go again. There's plenty of POs out there for March and April and May business that haven't been let off yet. You know, this is just the beginning of the, you know, we're not, if I had a lot of guys calling me going, hey, I need to move some inventory. Hey, I've got too much inventory. Hey, boss says get rid of it. I'd have a totally different attitude, but right now nobody's calling me and saying that. I'm just getting calls from people going, hey, can you ship this quick? And the market that is really trying to keep a low inventory and make that process work all the way through the height of the building season.
Are we going to have any transportation issues this year? I mean, that was obviously the theme. You know, I mean, one of the drivers over the last 2 to 3 years has been, you know, the transportation issue. Has the CN finally figured out that winter comes every year?
We haven't had any problems. So, I mean, that's different, right? Last year we had that big flood that knocked out the Sumash, the interchange coming from British Columbia down to the Washington, where they hand off the rail cars. Problem for all the West Coast states. We don't have anything like that this year. In fact, the trucking has gotten much cheaper. So remember how you and I and Ash were just scratching our heads last spring trying to figure out what we're going to pay for trucks. And then we'd book trucks and then they'd never show up and we'd have to rebook them 4 times to get somebody to, we're paying $3 or $4 a mile and, you know, we're getting in line. This year you can book long haul stuff for like $1.75, cases $1.50 a mile. So
and it actually shows up
a little bit too. I like that. It's back to, back to normal. This is the kind of business that you and me and Greg have done for years.
It actually shows up, Matt. Like you said, we booked a bunch of stuff out of the ports going all the way back into the Dakotas, as far as the Dakotas and Minnesota, because the rates were so inexpensive off the ports going back.
Listen, Ashley, I bought some trucks from Greg on Saturday, and 2 of them showed up on Monday morning from Florida to Texas.
Yeah.
I mean, that's.
Thanks, Greg. Good job, buddy.
On the Amazon of the lumber business, and it's only because you really didn't need them that quick that they got there.
Hey,
Overnight.
Charles was asking us. He said SPF gurus. How much will or has Euro compensated for any current or future curtailments?
Yes.
I'm not. I guess there's from what I see, the euro is going to keep coming right now. Is there going to be any more or any less from what you guys all see, or same amount? I mean, there's only so much dock space, so much, and so much vessel space.
I think at the margin, certainly at the prices that we got to, there are some shippers that may back off. That combined with, we've heard a lot of reports of ports saying, no, we don't have space. And, I heard one where a vessel had to sit out for 30 days and for $500,000 of I call it demurrage. It's something else if you're a vessel. And that's certainly gonna temper the shippers. I think we were in a situation in the fourth quarter where, the rest of the world, the prices were, the U.S. prices were the best of any place. And so they just sent so much stuff here in the fourth quarter. And, now you can see that in the relative prices, when, the price of 2x4 16s, in the Southeast is the same price as it is FOB the mill in British Columbia, or $100 below the Eastern price. That kind of tells you.
Can you explain that to some people listening?
Relative supply.
How inexpensive the actual premium 2x4 European 16s were relative to everything else in the market, from a absolute value and from a relative value, right?
Yeah. I mean, and if I look at that price, it's one of the prices that's moved up the least of any item. So, I mean, it probably has the least downside, and to kind of return to normal, the kind of a normal spread. I mean, realistically, it should be trading $50 to $100 higher than it is right now.
Yeah, no doubt about that. We talked a lot about, just real quick, about multifamily and home centers so far. Let's talk about the single family. They had the heavy lifting to do to start moving some stuff, to start digging some more holes and start building again, right? And as I go through, one of the things I love doing is going on to Lennar's website, Hovanian's, all of those, and looking at all their places and seeing where there's cuts in prices relative to quick moving stuff. So it looks like the quick moving items are still, people are doing stuff, but from what I hear, some of these guys are starting to dig some holes at the job sites again. Does that make sense?
Yeah, certainly in Texas, they've hit the ground running. And
go ahead, Matt.
Yeah, I mean, in my business in Texas, the big builders have come back in compared to where they were in December. For sure, they were busier in January, and I think that's good. That trend will continue in what I'm hearing and seeing. Now, I don't have the same reality in Colorado. I'm not getting that in Utah or Colorado or Idaho, but in Texas, Arizona seems. I guess it just has to do with where the weather is right now.
Yeah, I mean, I think when single family starts, I think we're down 21% last year, and I guess my sense is that that they probably that's probably leveled off, and there's not a big further decline in single family starts in 2023. And I think you and I, as we've talked about it, is, hey, listen, the reality is builder costs have fallen on commodity prices and on a lot of the other building materials. They're working real hard to squeeze those costs back down.
Yeah.
Yeah. Obviously, there's more available labor based on the January employment report. A lot of people that were doing other things now are going back to what they were doing before.
Good point. Good point. All right, boys. I got
Probably has something to do with that negative 1.5% money flow you were talking about, Greg.
Yeah,
When
isn't that
you
interesting,
turn off the
Matt?
spigots of free money, people decide to go back to work.
You kind of when you turn off.
I was trying to like do a checklist last night of all of the new programs that we wanted to institute. It sounds like, I mean, if we could just like spend more money on everything, the government, then that would solve all of our problems.
So, I mean, that's my biggest. I asked you last night, Greg, and without getting too political on this, I mean, okay, so you got negative. You're deflating it. All of a sudden, you could have one big program or something come in, and all of a sudden, you pump the bubble, you pump it back up again, right?
I think the reality with one of the great things about divided government is that it solves the old adage is that, like, the worst thing that you want to hear is that I'm from the government, I'm here to help you.
Yeah, no doubt.
Beyond that, actually, Fed chair came out and said, "Nah, that employment report is keeping us hawkish." So, or bearing the pedal on the economy in terms of keeping interest rates high. So that program is not gonna change as far as the Fed's concerned, which will help keep on me going crazy again.
One of the amazing numbers that Westbury gave me the other day was, with $5 trillion of excess reserves, let's just say so excess reserves, that means the Fed is paying banks for that money, right? It's $200 billion a year at 4%.
Yeah, well,
I'm just waiting for Elizabeth Warren to start run around with her hair on fire about that. How can we be paying the big banks $200 billion a year?
Well, that was my question. Why Chase wasn't giving me any interest yesterday, Greg? And you pointed me to the Treasury, how I can go get my 3-6 T-bills.
That's it.
Yeah. Go get yourself some 10 years, buddy.
You're right in there with Warren Buffett. I mean,
and I don't have to pay a state tax.
Who better to emulate?
All right, boys. Well, look, it was good talking to y'all. Greg,
all right, you guys.
Have a good time, Matt. And I'll talk to you guys later.
Thanks, guys. Have a great day.
Bye.
Bye.
All right, Mike. See you, Matt.
All right.
You too.
See you, Matt.